38%. More than one-third of the entire S&P 500 index, representing America's 500 largest companies, currently sits in just 10 stocks. 10 companies out of 500 control 38% of the total market capitalization. And here's what keeps me up at night. When those stocks start falling in 2026, and they will fall, millions of investors are going to try selling at the exact same time. But there's a problem. There won't be enough people willing to buy. I'm going to walk you through the precise sequence of events that will trigger this. More importantly, I'll show you what institutional investors are already doing to position themselves before it happens. But first, you need to understand why this concentration is unlike anything we've seen in modern market history. By the end of this video, you'll have a clear picture of what's coming and specific areas you can research to potentially protect your capital. Let's get into it. Right now, every major financial institution is publishing recession warnings. UBS puts the probability at 93%. Barron's Big Money poll shows institutional investors expecting market drops between 8 and 13% through 2026. JP Morgan's latest capital market assumptions are the most conservative they've published in 30 years. Everyone sees it coming, everyone's preparing, everyone thinks they're ahead of the curve. But here's the paradox. When everyone prepares for the same outcome, when everyone watches the same stocks for warning signs, when everyone plans to execute the same strategy, you create conditions for mass panic. The crash happens faster and harder because nobody wants to be last. What most analysts are missing is this: the crash won't be caused by fundamentals. It won't happen because these companies stop being profitable, or because AI disappoints, or because of tariffs or geopolitical tensions. Those are just triggers. The crash will happen because of liquidity, specifically the complete evaporation of it when everyone tries to exit concentrated positions simultaneously. Let me explain what liquidity actually means in practical terms. When you check your brokerage account and see your portfolio value, that number represents the current market price multiplied by your shares. You see that figure and think of it as money you have. But here's the reality. That number only becomes actual cash if someone else is willing to buy your shares at that price. Your portfolio value is theoretical until you find a buyer. And when millions of people try to find buyers at the same moment, the price you actually get can be radically different from the price you saw when you decided to sell. Think about a stadium. 50,000 people watching a game. Multiple exits throughout the building. During normal times, people leave gradually. The exits handle the flow without issue. Nobody thinks about capacity. Then there's an emergency. Suddenly, 50,000 people need to leave immediately. The exits haven't changed size, but now they're inadequate. People at the back can't reach them. People at the front get crushed. The infrastructure that worked perfectly well during normal times completely fails under stress. The stock market operates the same way. The top 10 stocks in the S&P 500 have a combined market capitalization of roughly $18 trillion. During normal times, when some people are buying and others are selling, liquidity is fine. Trades execute smoothly. Prices are stable. But when selling becomes one-directional, when everyone's trying to get rid of the same positions, the liquidity that existed during calm periods simply vanishes. The infrastructure breaks down. Now, let's talk about why this concentration is so dangerous. 40% of the S&P 500 in the top 10 stocks represents the highest concentration in recorded market history. In March 2000, right before the dot-com crash, the top 10 stocks represented roughly 26% of the index. Everyone thought that was insane, dangerous, unsustainable. They were right. The market crashed spectacularly. Today, we're at 38 to 40%, depending on how you calculate it. We've blown past the danger zone from 2000 and somehow convinced ourselves this time is different. The justification? These companies have real earnings. They're not speculative .coms. They have strong fundamentals, that's true. But fundamentals don't prevent liquidity crises. In fact, strong fundamentals can make things worse because they give investors false confidence right up until the moment everything breaks. Here's another data point that should terrify you. In 2015, just 10 years ago, the top 10 stocks represented about 20% of the S&P 500. Concentration has literally doubled in a decade, and that doubling has accelerated. Most of the increase happened in the last 5 years. What changed? Passive investing exploded. Index funds and ETFs became the dominant way people invest. When you buy an S&P 500 index fund, you're automatically buying these 10 stocks in massive proportion. You don't choose to overweight them. The fund does it automatically based on market cap. Tens of millions of investors poured trillions of dollars into index funds over the past decade. All that money flowed disproportionately and into the same 10 names. The buying was one-directional, passive, automatic. It pushed valuations higher, which increased market cap, which increased the weighting in the index, which triggered more buying. A self-reinforcing loop. But here's what nobody talks about. That loop works in reverse. When the selling starts, passive funds will dump these same stocks in the same disproportionate amounts. Automatic, mechanical, one-directional. And there's no fundamental analysis in a passive fund that says, wait, the valuation looks good now, maybe we should hold. The selling will be just as mechanical as the buying was. You might be thinking, okay, but I'm diversified. I own an S&P 500 index fund, maybe a growth fund, maybe a tech ETF, maybe a target date retirement fund. Different funds, different strategies, I'm spread out. Let me show you why that's an illusion. Your S&P 500 fund holds 38% in the top 10. Your growth fund probably holds 50 to 60% in those same companies. Your tech ETF might be 70% or more. Your target date fund, still loaded with them through its equity allocation. You don't own different companies. You own the same 10 companies in different wrappers. When Nvidia drops, all your funds drop together. When Microsoft stumbles, your entire portfolio stumbles. You have correlation, not diversification. And this matters enormously when we talk about liquidity. Because when the crash starts, you won't just be selling your S&P fund. Everyone will be selling all their funds simultaneously. The growth fund, the tech ETF, the retirement account, everything. And all those funds will be selling the same underlying stocks at the same time. The sell pressure will be multiplicative, not additive. Let's talk about what's happening right now that most people aren't seeing. The financial media focuses on price movements, earnings reports, Fed decisions. Those are surface-level indicators. If you want to understand what's really happening, you need to look at institutional holdings. Over the last 6 months, institutional investors have been reducing their positions in mega-cap tech stocks, not dumping them, not making headlines, just steady, systematic selling. A few percentage points here, a few there. They're using the strength in prices to exit. Meanwhile, retail trading volume, as a percentage of total market volume, has been climbing. Retail investors are buying. Every dip gets bought. Every pullback is treated as an opportunity. And who's selling to retail? Institutions. This is called distribution. It's a technical term that describes what happens at market tops. Smart money sells to dumb money. The informed sell to the hopeful. The people who understand risk management sell to people who believe prices only go up. You can see it in the options market too. Institutional investors are buying put protection on these mega-cap names at levels we haven't seen since early 2020. They're paying for downside insurance. They know something's wrong. They're preparing for volatility. Retail investors, they're selling puts to collect premium. They're effectively selling insurance to institutions, taking on the risk, because they can't imagine these stocks falling significantly. This divergence between institutional positioning and retail sentiment is one of the most reliable warning signs in market history. It happened before 2000. It happened before 2008. It happened before the COVID crash. And it's happening right now. Here's another piece of data that should concern you. Bank lending standards have tightened by 63% compared to last year. That's the most restrictive lending environment in 4 years. Banks are pulling back liquidity from the financial system. The Federal Reserve has kept interest rates elevated. They've been draining liquidity through quantitative tightening, reducing their balance sheet month after month. There's less money sloshing around the system than there was 2 years ago. Global debt stands at $315 trillion. That's 331% of global GDP. Every percentage point of that debt is leverage. Leverage amplifies returns on the way up, but it amplifies losses even more dramatically on the way down. Then there's the derivatives market. $600 trillion in notional value. Most people don't even know what derivatives are, let alone how they create hidden connections throughout the financial system. When one position blows up, derivatives ensure the damage spreads to dozens of seemingly unrelated positions. So you've got record concentration, you've got tightening liquidity, you've got record debt, you've got a derivatives powder keg, and you've got millions of retail investors all watching the same stocks, all planning to sell at the first sign of trouble, all believing they'll be able to exit smoothly. What do you think happens when one of these 10 stocks reports disappointing earnings? Let me walk you through the exact sequence of events. This isn't speculation. This is pattern recognition based on how every previous liquidity crisis has unfolded. Let's say NVIDIA reports quarterly earnings. Revenue is up, but growth is decelerating. Not a disaster, just slightly below the exponential growth rate analysts expected. Guidance for next quarter is conservative. The stock dropped 6% in after-hours trading. 6% isn't catastrophic. NVIDIA's moved 6% on random Tuesdays before, but this time, it's the catalyst everyone was waiting for. Market opens the next morning. Algorithmic trading systems see NVIDIA down. They're programmed to identify correlations. What moves with NVIDIA? Microsoft, Apple, Meta, Amazon, Google. The algorithms start selling those names too, even though nothing happened to those companies. They're just correlated with NVIDIA. Now you've got 4 of the top 10 stocks falling. They represent more than a quarter of the entire S&P 500. The index starts dropping. S&P futures go red. Headlines flash across financial media. Tech sell-off intensifies. By mid-morning, index funds have to rebalance. They're programmed to maintain specific allocations. When top holdings fall, the funds sell some and buy other positions to stay balanced. More mechanical selling. More downward pressure. Hedge funds see the momentum. They start shorting to profit from the trend. More selling pressure. By end of day, the top 10 stocks are down an average of 8 to 12%. The S&P 500 is down 5% in one day. Investors have lost trillions in paper value. That night, you're lying in bed. You open your brokerage app. Your portfolio is down 8%. If you had 300,000, you're now at 276. If you had $1 million, you're at 920,000. You lost $80,000 in one day. Your heart rate increases. Your hands feel cold. You tell yourself it's just a bad day. Market's correct. This is normal volatility. You'll check again tomorrow. Next morning, futures are down another 3% before the market even opens. Asia sold off overnight. Europe is plunging. The selling is global now. Market opens. The selling intensifies. Now you're looking at a 2-day decline approaching 15% from the peak. Your $1 million portfolio is heading toward 850,000. Your 300,000 is at 255. You make the decision. You're getting out, protecting what's left. You pull up your brokerage app and start placing sell orders, market orders on everything. The orders appear on screen. Processing. You wait. 30 seconds. 1 minute. 2 minutes. Still processing. You refresh the app. Still there. Processing. You try calling your broker. The automated system says current wait time is 75 minutes. You hang up. Go back to the app, keep refreshing. 5 minutes now. 10 minutes. Your hands are shaking. You're refreshing every 15 seconds. Finally, your first order executes. But when you see the fill price, your stomach drops. When you placed that order, the stock was down 17% from its peak. Your order filled at down 29%. In the 10 minutes your order sat there processing, the price collapsed another 12% because there weren't enough buyers at any price in between. Your second order takes even longer, 15 minutes to execute. That one fills at down 33%. Your third position, the largest one, sits pending for 22 minutes. By the time it executes, you're down 37% on that holding. This is a liquidity crisis. The market infrastructure completely breaks down when everyone tries to exit simultaneously. The price you see and the price you get come to entirely different numbers, and there's nothing you can do about it except watch your wealth evaporate while you wait for orders to fill. Now let me tell you about someone who experienced exactly this. March 2000, a software engineer in San Jose, 28 years old. Portfolio worth $823,000. Mostly in the tech stocks everyone said you had to own. Cisco, Oracle, Sun Microsystems, Microsoft, Intel. For 3 years he'd watched his portfolio triple. He read the financial news every morning, understood technology, knew how to analyze companies. He'd seen the warnings about overvaluation, but told himself he'd exit before any real crash. He was informed. He'd see the signs. March 10th, 2000. The Nasdaq peaked. He checked his account that night. 823,000. He considered taking profits, but thought, what if it keeps going? What if I miss the run higher? 2 weeks later, he was down 12%. He told himself it was normal volatility. Market's correct. By early April, he was down 24%. That's when panic set in. He decided to sell everything, protect what was left. He logged into E-Trade, placed market orders on all positions. The orders sat there pending for over an hour. When they finally executed, his Oracle shares had fallen 37% from where he decided to sell. Cisco was down 41%. The delay between decision and execution cost him tens of thousands of additional dollars. His portfolio value after everything sold, $608,000. He'd lost $215,000 in about a month. But the real damage came next. Those stocks continued falling for another year. Cisco eventually dropped from $82 to $11, down 86% total. Oracle fell from 46 to 10, down 78%. He didn't lose because he was stupid or uninformed. He lost because he was trapped in a concentrated market when liquidity disappeared. And the setup today is significantly worse. The concentration is higher. Passive investing has increased the mechanical nature of selling. More people own the same stocks through index funds than ever before. What destroyed portfolios in 2000 was market structure. Everyone owned the same names. Everyone tried to sell simultaneously. The infrastructure couldn't handle it. That's what's being built again right now, except with even more concentration and even more passive money that will sell automatically, without human judgment. Here's what most people don't see happening right now. While retail investors are buying every dip and celebrating corrections as opportunities, institutional investors are quietly repositioning. If you look at 13F filings, the quarterly reports that large investors must file with the SEC, you'll see a clear pattern over the last 2 quarters. Renaissance Technologies, one of the most successful quantitative hedge funds in history, reduced their Microsoft position by 11% in Q2 2025. Citadel trimmed Apple by 8%. Bridgewater reduced Nvidia exposure. These are small percentages, but when you're managing tens of billions, those represent massive dollar amounts. These institutions aren't selling because they think these companies will go bankrupt. They're selling because they understand risk-reward dynamics have shifted. The potential upside from here doesn't justify the concentration risk. They're taking chips off the table while liquidity still exists to exit at reasonable prices. Meanwhile, look at retail. Robinhood reported record account inflows in Q3 2025. TD Ameritrade saw retail trading volume increase 23% year over year. Reddit investing forums are more active than ever. TikTok financial influencers are telling millions of followers to buy the dip and dollar cost average into index funds. Every share institutions are selling, retail is buying. This is textbook distribution. It happens at every market top. The informed exit quietly. The uninformed pile in, thinking they're getting opportunities. And when the crash comes, retail gets crushed, while institutions are already positioned defensively. The options market tells the same story. Institutional investors have been buying put protection on mega-cap tech stocks at levels not seen since March 2020, right before the COVID crash. They're spending real money to insure against significant declines. That tells you they're genuinely worried about downside risk. Retail investors are doing the opposite. They're selling those puts to collect premium, taking the other side of institutional trades, effectively selling insurance to the people who know what's coming. When you see that divergence where institutions are buying protection and retail is selling it, that's one of the most reliable warning signals in market history. JP Morgan's private bank published research in September advising high net worth clients to increase cash allocations and diversify away from U.S. large-cap concentration. Citigroup's wealth management division is recommending clients explore defensive sectors, international exposure, and alternative strategies. These recommendations aren't broadcast to retail investors watching YouTube. They're going to families managing 8- and 9-figure portfolios. The information asymmetry is massive. Institutions know what's setting up. They're repositioning accordingly. Retail has no idea. And when the liquidity crisis hits, that gap in preparation will determine who preserves capital and who watches 30 to 50% of their portfolio disappear. So what can you actually do? Let me be extremely clear about something first. I'm not a financial advisor. I'm not telling you to buy or sell specific securities. What I'm going to outline are research areas that institutional investors are exploring right now, areas you can investigate yourself or discuss with a qualified financial professional. First, audit your actual exposure. Most people have no idea how concentrated their portfolios really are. Pull up every fund you own. Look at the top 10 holdings of each fund. You'll probably find the same names repeated across multiple funds. Calculate what percentage of your total portfolio is actually in those 10 stocks. If it's over 30%, you have significant concentration risk that most people would consider inappropriate for their risk tolerance. Second, research diversification strategies that actually provide diversification. Owning multiple funds that hold the same stocks isn't diversification. Real diversification means exposure to assets that don't move in lockstep with mega-cap tech. Some areas institutional investors are exploring, small-cap value stocks, which have significantly underperformed large-cap growth over the past 5 years, and are trading at historically cheap valuations relative to large caps. International developed markets, particularly in Europe and Japan, where concentration levels are much lower than in U.S. markets. Emerging market equities, which offer exposure to different economic drivers than the U.S. tech sector. Defensive sectors within the U.S. market that have been left behind during the mega-cap rally. Utilities, consumer staples, healthcare. These sectors typically hold up better during market stress because they provide essential goods and services that people buy regardless of economic conditions. They're not exciting. They haven't participated in the AI hype. But that's precisely why they might provide stability when growth stocks are selling off. Third, research the role of cash in portfolio construction. Most financial media treats cash as dead weight. Inflation erodes it. You're losing purchasing power. You're missing gains while the market goes up. That's true during bull markets. But cash serves a completely different purpose during market dislocations. Cash is optionality. When everyone else is forced to sell at terrible prices because they're fully invested and panicking, cash gives you the ability to buy quality assets at discounts. The people who built significant wealth in the aftermath of 2008 weren't the ones who held on through the decline. They were the ones who had cash to deploy when assets went on sale. The same thing happened in March 2020. The market dropped 34% in about 3 weeks. People with cash positions were able to buy stocks at prices that looked insane just months later. Within 6 months, those purchases were up 50, 60, 70%. But you could only take advantage if you had dry powder available. Institutional investors right now are building cash positions, not 100% cash. That would mean missing any remaining upside. But meaningful allocations, 15 to 20% for many, enough to deploy aggressively when the crisis hits. Research what cash allocation might make sense for your specific situation and risk tolerance. Fourth, research what happens to correlation during market stress. Most diversification strategies assume that different assets will behave differently. Stocks and bonds moving in opposite directions. Growth and value taking turns. U.S. and international markets operating independently. That's true during calm periods, but during acute stress, correlations spike toward one. Everything sells off together. In March 2020, stocks, bonds, gold, real estate, commodities all dropped simultaneously for about 2 weeks. The only thing that went up was cash and very short-term treasuries. Understanding that correlation breaks down during crises is critical for realistic expectations about how your portfolio will behave when markets are in panic mode. Fifth, understand the difference between paper losses and realized losses. When your portfolio drops 20%, that's painful, but it's not a realized loss until you sell. The real damage happens when you panic and sell at the bottom, converting paper losses into permanent capital destruction. The people who lost the most in 2008 weren't the ones who held quality assets through the decline. They were the ones who sold near the bottom and then missed the recovery. The challenge is that staying calm during a liquidity crisis is nearly impossible for most people. When you're watching your portfolio drop 5% a day, when orders aren't executing, when financial media is screaming about systemic collapse, the psychological pressure to do something, anything, becomes overwhelming. That's why positioning before the crisis is so important. If you're properly diversified and holding appropriate cash levels before stress hits, you won't be forced to make decisions in panic mode. Here's what I want you to understand. Most people watching this video right now will do nothing. They'll nod along. They'll think, yeah, that makes sense. They'll save this video, maybe send it to a friend, and then they'll do absolutely nothing to change their positioning. Why? Because the human brain is terrible at preparing for future threats. We evolved to react to immediate danger, a predator in the bush, a snake on the path. Our survival instincts are calibrated for present-moment risks. But financial threats build slowly. Everything seems fine until suddenly it isn't, and by the time your brain registers danger, the damage is already done. The people who will survive and potentially profit from what's coming in 2026 aren't the ones with the best information. You have the information right now. The winners will be the ones who act on information while everything still feels okay, while the market is still making new highs, while their friends are still making money, while taking defensive action feels stupid. That's the only edge that matters. Doing the uncomfortable thing now so you don't have to do the catastrophic thing later. Positioning while the exits are still open. Diversifying while liquidity still exists. Building cash while everyone else is fully invested. When you look at your portfolio a year from now, in late 2026, what do you want to see? Do you want to be down 40 or 50%, like most people will be? Do you want to be the person who tried to exit during the crash and got terrible fills? Do you want to be explaining to your family why you lost half your retirement savings, even though you knew this was coming? Or do you want to be one of the few people who positioned correctly beforehand? Someone who preserved capital when others lost it. Someone who has cash to deploy when quality assets go on sale. Someone who can tell their friends exactly when they made the moves that saved their portfolio. The choice exists right now. Today. This week. Once the crisis starts, there won't be good options anymore. There will only be damage control. The liquidity will be gone. The exits will be jammed. The only question will be how much you lose, not whether you can protect yourself. I need you to do something right now. Leave a comment telling me whether you're actually going to take action or whether you're going to wait and see. I want to know. Because when we look back at this video in a year, I want to see who listened and who convinced themselves they'd be fine. Most of you won't comment. Most of you won't act. And that's exactly why most investors lose money. They treat information like entertainment instead of instruction. They watch, they learn, they understand, and then they do nothing. They wait for more confirmation, more evidence, more signs. And by the time they get all those things, it's too late. The crisis has started. The exits are jammed. The wealth is gone. Prove me wrong. Take the action. Research the areas I outlined. Talk to a financial professional about your specific situation. Build a plan. Execute it this week, not next month. Position yourself before everyone else figures this out. Because in 6 months, when the crash everyone's predicting finally arrives, the only thing that will matter is what you did today.